to Iron Financial. This is the workshop where we forge stronger portfolios by putting companies on the anvil and seeing if they can take the heat. We don't do hype here, we do pressure tests. And today, the titan under the hammer is KLA Corporation, an absolute cornerstone of the semiconductor industry. All right, let's get to it.
Okay, analysts, let's just get right into it, no warm-up. This is the puzzle that's got Wall Street talking, and probably a lot of our viewers scratching their heads. KLA, by all accounts, drops a fantastic record-setting quarter. They beat on revenue, they beat on earnings, the machine is firing on all cylinders. So why on earth did the market turn around and give the stock an 8.5% haircut? What did the pros see that maybe the headlines missed? That right there, that's the disconnect we're going to hammer out today.
And that is exactly why we're here. Look, anyone can read a headline that says record quarter. That's the easy part. Our job is to get out the schematics, to analyze the structural integrity of this entire report, from the foundation to the roof.
Right. And my job is to look for the hairline fractures that everyone else ignores. We need to figure out, is this 8% dip a golden opportunity to buy a best-in-class company on sale? Or did this earnings report just expose that the whole structure is riddled with cracks, just waiting for the next tremor to crumble under the pressure?
Okay, let's get to work. Before we even think about looking for weakness, we have to respect the strength. And to do that, we start with the cold, hard data, the undeniable facts from the earnings release itself. We're going to build the bull case, piece by piece, number by number, to see just how solid this company's foundation truly is. This is the heavy lifting, so pay attention. We start right at the top, with the words from the man in charge, CEO Rick Wallace. Now, listen carefully to what he's saying. This isn't just one shiny metric he's pointing to. He's claiming the triple crown of financial performance: record revenue, record operating income, and record free cash flow. When a CEO can say that, it's meant to signal one thing: flawless execution.
Well, it's the story they want to tell for sure. It paints a perfect picture. But CEOs are salespeople too. Let's see if the actual numbers back up the beautiful language.
Let's start with the top line, revenue. The company brought in $3.3 billion for the quarter. Now, a number that big can feel a bit abstract, so let's weigh it against the only thing that matters on Wall Street: expectations. The consensus, the average guess of all the analysts, was for $3.26 billion. So, KLA didn't just stumble over the line, they cleared it with $40 million to spare. In this game, that is a solid, undeniable beat. It tells us that demand for their complex equipment is strong and their teams are out there closing massive deals. That's the first pillar of the bull case, and it is solid steel.
Next, let's move down the income statement to the bottom line, the number that really gets investors excited: non-GAAP earnings per share, or EPS. This tells you how much profit the company is making for each share of its stock. The street was looking for $8.80. KLA delivered $8.85. Again, it's a beat. This is crucial because it proves the company isn't just growing its sales, it's doing it profitably. They're managing their costs, they're protecting their incredible margins, and they're turning that giant revenue number into actual, tangible earnings for shareholders. Pillar number 2 is just as strong as the first.
And now for my personal favorite metric. This is the one that tells you the true, unvarnished health of a business: free cash flow. For the quarter, KLA generated a staggering $1.26 billion in free cash. This isn't some accounting gimmick. This is the cold, hard cash that's left in the bank after all the bills are paid and all the necessary investments in the business are made. This is the financial bedrock of the company. It's the oxygen. It's the money they use to fund groundbreaking research, pay dividends to investors, buy back their own stock, and, most importantly, weather any economic storm that comes their way. $1.25 billion in just 3 months, that is a financial fortress. So let's put it all together right here. This slide lays out the clean sweep. Look at it. Revenue, a beat, showing solid 7.2% growth over last year. Adjusted earnings per share, another beat, up almost 8% from the year before. And then there's adjusted EBITDA, a really key measure of a company's core operational profitability. They hit $1.5 billion when Wall Street was only looking for $1.46 billion. It's a trifecta. You simply cannot argue with these numbers. This isn't just one part of the business doing well. This is a story of total, comprehensive operational excellence. Okay, I'll grant you that. On paper, I'm looking at a foundation made of solid steel rebar. The bull case is strong, no argument here.
And it's important to know we're not the only ones seeing this strength. This wasn't happening in a vacuum. Look at the institutional validation. Just a month before this report came out, the analysts over at Jefferies upgraded the stock to a buy. And look at their reasoning. They believe the semi-cap run was just beginning. This wasn't some wild guess. This was a major Wall Street firm with all its resources telling its biggest clients that KLA was perfectly positioned to ride a massive wave of capital spending in the AI and semiconductor space. The smart money was already placing its bets and building their positions based on the exact fundamental strength that we just detailed. The bull case is not just a story, it's data-driven, and it was validated by the street.
All right, that's a very compelling case. A fortress, you called it. Well, you know what they say. A fortress is only as strong as its weakest point. And the market, with that 8.5% drop, clearly found one. So now, it's my turn. I'm picking up the sledgehammer, and my job is to find the cracks in this shiny armor. Because buried somewhere in this report, or maybe just outside of it, there was a weakness that completely overshadowed all of that incredible strength. Let's find it.
And here it is. This slide tells the entire story in two simple columns. On the left, you have that impenetrable fortress the analysts just built for us. Record revenue, record earnings, record cash flow. A masterpiece. But on the right, you have the market's brutal verdict, an 8.5% demolition job. So if the numbers were so darn good, why the violent sell-off? The answer is simple. The market is a forward-looking machine. It doesn't really care about last quarter's records. It was looking through these numbers, past them, and it saw a threat coming on the horizon.
You know, the first crack isn't even in the earnings report itself. It's all about context. Just look at this chart. In the single month leading up to this earnings report, KLA's stock ran up by a blistering 29%. Let that sink in for a second. A nearly 30% gain in about 30 days. That's not a gentle climb. That's a vertical rocket launch. And that kind of run-up builds impossibly high expectations into the stock price. The market wasn't just hoping for a beat, it was priced for a massive, historic, blowout quarter with guidance that shot for the moon. So when KLA delivered only a really solid quarter, it felt like a letdown. The structure was already under enormous tension, and the report just wasn't strong enough to stop it from snapping back.
So now let's get specific. What were the actual cracks in the report itself? Here are the four big worries that analysts and investors immediately latched onto. First, decelerating growth. Yeah, revenue grew 7.2%, but this was the third consecutive quarter that the rate of growth has slowed down. The market sees a trend there, and it's a downward one. Second, the margin guidance was weak. The company guided next quarter's gross margin to around 61.75%. That might sound incredibly high, but for a premium company like KLA, it signals potential pressure on their profitability. Third, elevated inventory. We'll dig into this more in a second, but it's a potential red flag for future demand. And finally, that super-wide EPS guidance for the next quarter. A range of over $1.50, from $8.30 to $9.86, that suggests a pretty significant degree of uncertainty from management themselves. That lack of precision makes investors really nervous.
Okay, let's focus in on that inventory issue, because it is a critical stress point for any manufacturing company, especially in a cyclical industry like semiconductors. Days Inventory Outstanding, or DIO, basically tells you how long a company's very expensive product is sitting on the shelf before it actually gets sold. Now, to be fair to KLA, their DIO did drop slightly from the previous quarter, which is a positive sign. It shows they are actively managing their balance sheet. But let's be crystal clear here. At 2,305 days, it is still historically very high compared to its 5-year average. Think of it like this. It's a leading indicator. It suggests that supply might be starting to get ahead of demand. And if that trend continues, what does it lead to? Potentially price cuts and lower margins down the road. It's a subtle crack, for sure, but it's one that could widen into a massive chasm if that trend doesn't reverse.
All right, now we need to pull the camera back. We need to zoom out. This story isn't just about KLA's foundation. This company is part of a much larger structure, the entire semiconductor equipment sector. To really understand the pressure that KLA is under, we have to apply a stress test to the whole industry. Was this sell-off an isolated tremor affecting just one building, or is the entire ground shaking for everybody? And this quote from the 24/7 Wall Street Live blog really just sums it all up perfectly. Semiconductor equipment stocks have been on fire. That is the key phrase. Just like KLA, the entire sector had an incredible, unbelievable run. You look at names like Applied Materials, Lam Research, ASML, all of them were soaring into their earnings reports. The whole neighborhood was priced for absolute perfection.
Which means the bar for success was raised to an impossible height for everyone. When you're trading at these kinds of elevated multiples, a good quarter is essentially a failing grade in the eyes of the market. As the quote says, moderate beats will be punished.
Exactly. KLA wasn't punished for being a bad company. It was punished for being a great company in a red-hot sector that demanded a level of perfection that is almost impossible to deliver.
Let's put some hard numbers on that valuation, because this is critical. KLA trades at a forward price-to-earnings ratio of 37. That is a rich valuation. There's no way around it. Now let's compare it to a key competitor, Applied Materials. Their trailing PE is even higher at 39, so the whole neighborhood is expensive. But here's the really critical detail. KLA's operating margin is a stunning 41.7% compared to just 28.4% for AMAT. It is a much more profitable machine, and you could argue that its best-in-class performance justifies that premium valuation. But, and this is a huge but, it also creates a razor-thin margin for error. When you are the best-in-class operator, the market doesn't give you any grace. Investors expect perfection. So any sign of margin pressure, like that weak guidance we talked about, becomes a major threat to that whole story. It's like you're paying for a flawless diamond, and the second a jeweler finds the slightest inclusion, its value can get shattered.
And this right here, this is what was fueling that fire across the entire sector. The night before KLA reported, their big competitor, Lam Research, comes out and drops an absolute blockbuster of a forecast. They projected the entire market for wafer fab equipment, that's the core business for all these guys, to grow from $110 billion in 2025 to a massive $135 billion in 2026. That is a $25 billion expansion of the entire market in 1 year. That forecast sent a wave of pure euphoria through the sector. Investors heard that number and immediately thought, well, if the whole market is going to boom like that, KLA's report tomorrow better be absolutely incredible. It set an almost impossibly high bar that even KLA's record-setting quarter couldn't quite clear. Okay, we've laid out the evidence, we've forged the bull case, built on a foundation of record-breaking performance, and the skeptic has taken the sledgehammer to it, exposing the cracks of impossibly high expectations, decelerating growth, and intense sector-wide pressure. So now it's time to step back, weigh all the evidence, and forge our final verdict. Is KLA a solid investment opportunity, or is it a beautiful structure that's just waiting to fall? This slide really lays it all out, the two sides of the coin. On the left, you've got the foundation. This company is an undisputed market leader in a critical part of the tech world. They just printed record numbers across the board, and they're riding the unstoppable tailwind of AI. They have a long history of excellent execution. But on the right, you have the cracks that you just cannot ignore. That decelerating growth is a real trend. The margin guidance was a clear disappointment. The valuation is lofty, leaving absolutely no room for error. Inventory is still elevated, and that wide guidance range screams uncertainty from the people who know the business best. You have to weigh both sides. So here is our final verdict. KLA Corporation is a structurally sound, best-in-class company. The foundation is absolutely solid steel. This is a titan of its industry, a company that is critical to enabling the entire AI revolution. However, its valuation before this report had been pushed to a level that made it a dangerous high-wire act. The stock was priced for a level of flawless, godlike perfection that this quarter it just didn't quite deliver. Put simply, it's a great company that was saddled with an impossible stock price. So what does this actually mean for your portfolio? Well, it depends on who you are. If you're a long-term investor, your focus should be on the foundation. You look past the quarterly noise, you look at the market leadership, you look at the AI tailwinds. For you, this 8% dip might be the exact buying opportunity you were waiting for to own a piece of a world-class company at a much more reasonable price.
But if you're a short-term trader, you have to heed the warning signs. You have to beware the valuation. This stock is now in the penalty box with investors. Any more execution missteps, any negative shift in market sentiment could cause a lot more pain. The High-Wire Act is still in progress, and right now, the safety net is gone.
And that brings us to the final question we always ask here at Iron Financial. We've stress-tested this one company, but have you done the same for your own holdings? When the market applies unexpected, sudden pressure, is your portfolio built on a solid foundation of fundamentals that can withstand the shock? Or will it crack under the strain? That's the work you have to do. Thanks for joining us in the workshop.